Hello, friend. This is Rajadhar, and today we are talking about investment strategies among global and Indian market volatilities. We will break down into three broader segments. First thing, what has happened globally and in Indian markets. Secondly, we will be working on where do we stand as an economy right now, and thirdly, where are the investment opportunities for Indian investors and how they should structure their portfolio. So these are the three broader elements. Now, current market scenario. If we look at the current market scenario, we have seen Indian markets getting corrected by the highest in a single week over the last 2 months. Yes, in the last 2 months, it has been the most steep fall in the Indian equity markets. Now, there are a couple of three reasons that are primarily held accountable for it. First, there has been a global uncertainties and macroeconomic issues. That is the first element. Then the FII's outflow has been there, and the thirdly, the quarterly results that we are expecting are a mixed bag, not so good. So therefore, there is no technically a positive news that will help Indian markets to gain ground. Not only that, Indian currency has also fallen a lot over the last 1 month, if we would see, and also over a week, if we will see for that matter. Now, on the global front, we know that there are the protectionist policies that are being levied by the US. However, the impact on India is going to be limited because India's export basket is not too big to be impacted to that much account. Moreover, we are not that much into more finished goods than in the startup in the startup value chain of our exports. So that is one element to it. However, that has not the only issue. The main issue has been the currency. Because of these news that has also going there has been a currency depreciation, and due to currency depreciation there has been a trickling effect of the inflationary spillovers. Now, even if you think that if Indian repo rate down would be there, or the better monsoon would be there, but if global economic uh, mixed bag is there and the currency keeps on depreciating, we have a very big import bill. Since we have a very big import bill, we will not be able to contain inflationary pressure. So therefore, the cost of funds and all other things, the cost input cost to our products will not be that averaged out. So therefore, will not be a good for Indian economy by and large. So this is the first thing. So when we look secondary effects, they are like currency depreciation, there are inflationary spillovers and shifting global supply chain. So that is one element to it. However, when we say where does India stand in comparison to the other emerging economies, we are much robust and much better placed because of the broadly three factors. First, we have a very huge domestic consumption base, which will keep the economy going. The second thing is that we government is still spending too much on infrastructure expansion, although there are limitations to which they would be now doing, but still we are having that. Thirdly, we are having a robust financial sector with us. So these are the three things which still are good strategic from a strategic point of view as far as Indian markets are concerned. Now, when we look at all these perspective, the next main question comes: where do we stand as an economy? And what are good and bad things? Now, from the economic standpoints, there are two contradictory concerns or narratives that are there. On the one hand, we are having a very slow and steady but very slow economic recovery. The second point is that the government is following the financial prudence, so therefore government will not be spending too much on infrastructure, or will be curtailing or keeping it in a limited, not going gung ho over it, or on a front foot. We would not be expecting that. Then there is an uncertainty in the global liquidity. So these are the three factors. But among all these, the second narrative, that is the bullish one, is there are certain pockets where we are seeing growth. So where are they? Firstly, we are seeing certain structures like banking, sectors like banking, infrastructure, and manufacturing. We are seeing robust demand and also ongoing capital investments. So at one end, where we are seeing economy is slowing down, but there are certain sectors within Indian economy that are still bullish. While the FIIs have taken money out of the Indian markets, but we expect that seeing that trend to soon get reversed, provided US cuts its repo rate and Indian markets also become stable over a period in time, because government of India has shown its a firm stand on pushing the economic India back on the economic path of recovery by improving on taxation and infrastructure, and has taken various policy reforms, whether it is taxation or infrastructure investments for that matter. Now, due to this, the private capex has also started getting into the sectors like as specialty chemicals, capital goods, and manufacturing for that matter. Now, when we look at this perspective, then as an investor, you would be looking at which are the sectors or the segments where I should focus. Now, when we look from the valuation point of view, the first sector or a segment that we are looking at is banking, because there are many large cap banks which are at a very good valuations available right now. There is a good credit offtake, there is a credit demand. People and institutions need to take more and more loans, so there will be a growth in their book size. And then lastly, the interest rates are also favorable to the bank because the interest rates are still higher and they will be having making more on the net interest margin. Then second is the infrastructure and capital expenditure. We still know that the government is spending on infrastructure expansion and private capex like constructions, engineering, and industrial goods. So these are the another sectors in which we can look expansion growth, even in the current downward spiral of the markets. Third is the discretionary spending. Now we know that the government of India has taken certain initiatives by which the taxations, or you can say there has been a release of more financial incentives by way of reduced taxes and more money in the hand of rural population as well as urban city citizens. So therefore we can see that money flowing into consumer durables or autos, two wheelers, or discretionary spending for that matter. While that is one aspect of it, then this also brings us to, and where India is trying to strengthen its hold, that is into specialty chemicals. While China plus one policy is being followed by many of the countries, so India is also pushing itself into manufacturing and sale and export of the specialty chemicals and the contract manufacturing for that matter. So this is one element. While on the other side, IT and IT services are there at a good valuation point, but still there are quite, you can say, sector risks to it because of the disruptions that we can expect from the artificial intelligence and all other automations. We have to see how that would pan out. But semiconductors and EV solar panels are the one element where you can still look to diversify your portfolio. So this is one element where we have seen how sector positioning could be done. But on the other hand, if you want to do it from a broader portfolio point of view, which would be having a mixed bag of the stocks, how you should structure the portfolio. First and foremost, we know that there are the large cap stocks. Now that large cap stock should be the cornerstone of your portfolio. So these large cap stocks should be those which are good value buys, particularly in banking and infrastructure for that matter. A couple of them manufacturing, but banking and infrastructure per se. When you go for a mid caps, you can focus on those which are manufacturing of into specialty chemicals or the high growth structures, and which are also fundamentally strong. But this is for the mid cap. But if you still want to have small caps which are the very high valuation, you should only consider those stocks which are having a very good balance sheet and very high growth prospects. If they're having a good balance sheet, that means they're a stronger company, they can withstand the downward trend into the market, they have the cash to fight back on and still retain their market share. So good strong balance sheet companies with a growth visibility over the next 6 to 9 months, those are the small caps which you can look forward. While you are having a mixed bag of large, small, and mid caps to your portfolio, you have to diversify your assets. Yes, gold is the one standard that we always have in our kitty, but you can also mix it up with your fixed income securities, because if the rate of interest is going to fall, repo rate is going to fall, the fixed income assets will give you a double digit returns that we can expect over the next 1 to 2 year horizon period. So this is one. Then you can also, for HNIs, you can also have an AIFs which are structured to the real estate or any other type of the asset class which is unlinked to the broader equity markets as a part of the hedge. And while you do all these things, your perspective has to be the long term. Now, long term, why I'm saying long term, when the market corrects sharply, it provides you very good attractive points in positions and very good value buys in very good large cap stocks. And these companies will multiply your wealth over a medium to long term. So you cannot expect you have got even a good company at a low valuation in the current market scenario in a month of say February, and you are expecting in the month of May I will be able to make 15 or 20% return of it. Then that means you are short sighted. You are not able to gauge where the economy is going on. So the matter of fact is, it is a long-term perspective that you need to have. Now, despite volatility that is there in the Indian markets and the global markets, India is still having a very structural growth drivers in place. So whether you talk about domestic demand, robust financial markets, spending on infrastructure and manufacturing, so with these things, we can still consider the Indian market with resilience. The only issue with Indian markets have been that Indian stocks have been very grossly overvalued. So what the fall you are seeing is the overvaluation being ripped off and getting chiseled down to a muscular stocks at the right valuations that are present into the market. Therefore, if in case you are structuring your portfolio, you need to be well versed that don't expect to make double the money in next 1 year or 2 year period. If you are invested in this current period when the market returns are nearly negative, in next 1 or 2 years you will be making a decent return. The point is not to time the market, but your time into the market. If you're not timed into the market, you will never be able to make money. So with this, this is Rajada signing off. Have a great day. Thank you so much.